Joining us now is U.S. Bank Asset Management Group Senior Investment Strategy Director Rob Haworth. He manages a cool $530 billion. Rob, great to have you here. So do you like AI? Do you still like big tech? What do you say about trying to get in on the AI trade?
Yeah, Taylor, thank you so much. So great to be with you. We do think there's more room to run for artificial intelligence investing. The first phase of this cycle has really been, to your point, some of these big names, the infrastructure of artificial intelligence, those building the models, the names you mentioned, as well as those providing the chips, NVIDIA, Microsoft, Google, others. We think it's time for this to broaden out, right? You need power to build this. You need data centers. You need other factors to support it. So that, we think, means we start to see better performance coming out of industrials and utilities. And you're starting to see early phases of usage, right, and usage implementation. And we think that means healthcare, particularly when you think about robotics, insurance, data and other logistics in the healthcare industry, right? We should see this rally start to broaden out as we move beyond just the primary builders of the large language models into those who are supporting them and then using them.
Yeah, you're hitting on a theme that I've read, that we've moved from the enablers, the chip makers, to the applicators, who's actually now applying all of that, and you hit on all of those sectors. On that note, where do you see the biggest earnings growth next year when you think about sectors?
Well, technology is still really in the lead, right? We should start to see others catch up, but it's tough to beat some of those technology growth numbers when you think about the absolute volume and scale of investment that has to happen. That rate of growth in investment is slowing, but the scale is still large enough that it's probably technology and communication services that maintain that lead in 2026.
We only have about 30, 40 seconds. What are you thinking about consumer debt delinquencies, especially going into next year?
Yeah, the consumer remains the linchpin of this economy, and we need to see them continue to benefit. We are watching some of the debt trends, but it looks like that growth rate in delinquencies is starting to flatten out and soften. And so particularly as long as we see unemployment remain modest, right, there's room for consumers to service that debt, and we should be okay in the new year.
Okay, Rob Haworth, really appreciate your time and for joining us today.